At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes, only algorithms.
Let Staples Business Advantage use today's latest innovations plus our team's experience to make furnishing an office space easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
This is a Shares for Beginners quick tip. Essential lessons. Questions answered.
What are the common ratios you should learn before building a portfolio? I know I go on about metrics and ratios, but they're important to understand. It's what expert investors use to run the tape measure over companies. Matthew Hodge is a Director of Equity Research for Morningstar Australasia. In this quick tip, he talks about return on invested capital. He explains how this ratio can show how much return a company generates for every dollar of capital invested. It's like getting a sneak peek into the company's potential for profit. Measuring return on invested capital eliminates the bias of return on equity, which can be distorted by financial leverage or the amount that the company has borrowed. He also mentions the legendary investor Warren Buffett and his wise words on having a punt card with 20 slots. If you can only make 20 investment decisions in your lifetime, each one should be approached with conviction and careful consideration. Above all, Matthew says to invest in yourself, expand your circles of competence, and keep upgrading your mental software.
Where do you want to start, right? So I think starting where you know, where you've got a fair idea, is probably not a bad place to start, right? And then you can do the research and do the learning and the education piece to start to understand other industries, right? That's kind of how I would suggest perhaps going about it. Yeah. So, and if you did start with, you know, what I was kind of suggesting, where the majority of your money is in an index fund and you're really not taking any swings at that, then you can really focus on the ones where you do understand them. And I think that is important. I think Buffett also talks about, you should have a punt card with 20 slots, right? And you should think very carefully about the slots that you punch when you buy a stock, right? Because you don't get many swings. And if you did that, had that discipline, you'd be a much better investor.
How does that work? I haven't heard about that concept of the...
Well, I think he's trying to say, like, if over your investing lifetime, you can only buy 20 things, right? When you go to buy something, you have to have real conviction. Hey, I'm using 5% of my purchasing decisions in my life here. This really has to matter, and I really have to have strong conviction and understanding around this, as opposed to this chart's forming a diamond pattern and I'm selling this one and buying that one. I mean, I don't know if you've talked about the stats on traders in this podcast, but most of them lose a lot of money, which is why they have nice businesses and fancy ads. They want more. It's not that far away from gambling.
Another guest that I was just speaking to was talking about the whole GameStop phenomenon in the United States.
Yeah.
And how it came at a time when there was no sports betting. I mean, sports betting has only just been legalised, which I find insane in the United States.
Yeah.
On a federal level, not in every state, of course. But then during the pandemic and the shutdowns, there was no games to bet on. And that was one of the driving factors behind the GameStop phenomenon.
Yeah, I think the amount of money that was in the market as well, the amount of fiscal and monetary support that had been pumped in the economy, and there was just money sloshing around,
and nowhere to spend it.
And you saw it in cryptocurrency, and the market itself was going really well. You want to talk about timing the market, those are the things to look out for and say, hey, perhaps I should be a little bit more cautious here, right? Like, there's some crazy stuff going on here. I'm pretty sure that won't last. I don't know when it will stop, but I need to make sure I'm not taking excessive risk here, right? Because at some point there will be a comeuppance.
So presuming that a listener does want to take an interest in researching companies a bit more, what are some of the common ratios that they should learn about before building a portfolio?
Yeah, I mean, I think Howard Marks talks about this, among others, is, people are looking for a formula and a number, right? And if it's formulas and numbers, there's a whole army of quantitative analysts out there mining that stuff, right? So it has to be more than that, right? So you need to bring the qualitative understanding to bear as well. Having said that, return on invested capital is one that we particularly use at Morningstar. So for every dollar of capital invested in this business, how much is it going to return you every year? Is it going to return you 10 cents, 10%, or is it going to return you 20% or 50%, or is it going to return you 5%? That's one piece of information, right?
And where can you find that number?
Well, where I would find it is we've got a data product called Data Analysis, which I use religiously. I don't do many things religiously, but that is one. And so I can go to there and use that, but our products will have that. So I think morningstar.com.au, you'll be able to find for specific stocks, you can screen and find things like that.
And invested capital, what does that represent?
It represents the assets of the business, right? So if we're talking about BHP, it's the cost of the trucks, the plant, equipment, the processing plant, what they paid to build the mine, essentially. That would be the invested capital base, which is the denominator in the equation.
Yep.
And the return is kind of the after-tax return after excluding any kind of interest payments, right? So the benefit with using return on invested capital is it says, let's pretend this business is completely ungeared. And why does that matter? Okay, well, if you use a return on equity, what happens is you might have a business that's generating a modest excess return on invested capital, but if you gear it up 5 times, the return on equity looks amazing, right? It can be 20, 30, more percent, right? So if you're using return on equity as a screen, because it's got that financial leverage factor in there, it can lead you into risk taking. So if you're in really good times, right, and you're searching for return on equity, really good times is when these businesses tend to get geared up. The market may be somewhat cautious on these names, so have an understanding of greater than average financial risk. And so they'll show up nicely on a PE. You do a return on equity and PE screen, you're essentially screening for overgeared companies, right? And then, okay, market turns down. It's like, whoa, these are the businesses that are more likely than not to get hit, right? So
return on invested capital is something that gives you a more accurate overview of the potential of the company.
It doesn't have that bias, right, of return on equity. A lot of people use return on equity and it's fine, but you just need to understand that.
There is a difference, isn't there? Yeah.
Yeah. So if you're deeply interested, if you just Google DuPont analysis, then pull up the wiki page, I find DuPont analysis really, really useful as well. And it basically disambiguates the return on equity into 3 parts. It's like the net profit margin, the asset turnover, so how much revenue for every dollar of assets you've got, and the leverage factor, so how much financial leverage, right? And why that's interesting is it can tell you, is this a high margin, low turnover business? Is it a low margin, high turnover business like a supermarket or something like that? Is it very capital intensive? So, mining companies, their asset turnover might be 1 or something like that. As opposed to a SaaS company, the asset turnover might be humongous, right? So, and all of those factors multiply together, right? So if you've got something that is high margin and high asset turnover, you can generate phenomenal returns on equity, right? Like in some of these, web-based businesses, like a Facebook, every dollar that comes in is basically incremental profit, right? So it kind of depends what the business is, right? So, if it's a SaaS business, you care about growth, user numbers, engagement, time on site, things like that. If it's a mining company, you care about where it sits on the cost curve, so what's the production costs, If it's a bank, there's all sorts of things you want to know about. You want to know about the capital ratios. Is it well capitalized relative to peers? It seems like banks are too big to fail. So on that basis, you just want to make sure you're in the top half, I guess. You don't want to be the worst bank because, if there is something like the bad that ever happens, you just don't want to be in the worst one,
You've mentioned a couple of authors. What are some of the publications and books that you would suggest investors reading?
The question itself presumes that reading is the only way to learn, right? Which I disagree with, right? We are fortunate to be in a position where there's just been an absolute proliferation of different kinds of media, right? If I'm honest, and I feel a bit bad about this, I don't read a lot of books anymore. I get on my bike, go for a bike ride and I listen to podcasts, right? Or I listen to something on YouTube, right? So all of the Berkshire Hathaway AGMs, they're all on YouTube. I think I've ground my way through all of them now. And I think you do that once, maybe twice if there's something really interesting. And they give you a lot of good ideas and fundamental mental models, right? So Charlie Munger's book, who I highly recommend, Poor Charlie's Almanac, talks about developing mental models, right? So there's some that I really like. Howard Marks is great. There's this podcast called Farnham Street, and he's another Buffett disciple that's really interested in mental models. So I think whenever you're learning and whenever that learning has longer term value, you're kind of compounding your own value, right? So I think Buffett and Munger both talk about number one, invest in yourself, right? So I think that's key. And it may feel like I don't really have an hour in the day to do this, but if you do, right, it's going to be obvious over time that you're learning and advancing relative to the people around you, and you'll be running different software. It's just getting a software upgrade, right? So you want to be running the best software and not just relying on what you've got or what you feel comfortable with.
Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
Recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
At Staples Business Advantage, furnishing your office is easy. And with the best warranty in the business, we're committed to you now and down the road.
Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.